Number 5.
According to Pass 8, the following are grounds to change an accounting policy except A. If it is required by IFRS, B. If the president or CEO of the company decides to change an accounting policy with the approval of the board of directors, C. If it results in the financial statements providing more reliable and more relevant information and thus not mislead the users, D. All of the above are grounds to change an accounting policy. Our answer, sir, is B because it is not explicitly stated in the standard as a grounds for change of accounting policy.
Okay, so letter A and C are provided in the standard, correct? Letter C is what we refer to as your voluntary change, while letter A is what we refer, although the standard does not call it mandatory class, we are going to call letter A as a mandatory change. Letter B is not among those identified in the standard. Okay, let's proceed to number 7.
Which of the choices best describes the following statement? As provided by past 8, if it is impracticable to determine the cumulative effect of the error at the beginning of the current period of an error on all prior periods, the entity is not required to restate anymore. A change in accounting estimate, like a change of the residual value of a depreciable asset, shall be applied prospectively. The first statement is false because the entity is still required to restate by restating the opening balances of assets, liabilities, and equity for the earliest period for which retrospective restatement is practicable. And the second statement is true because a change in accounting estimate is shall be applied prospectively.
Okay, so that's correct, class. You will still have to apply it retrospectively, but the effect would just be reflected on the opening balances, class. And if it's difficult to identify what asset or liability class, then it will just be reflected on the retained earnings. Okay, if you cannot identify what accounts will be affected, class, the account that will be adjusted would be the opening balance of your retained earnings. That's very important, class. Please do not forget that the last option, class, for retrospective application is to adjust the opening balance of your retained earnings.
Number 9, which of the following items requires a retrospective restatement? So our answer is letter C, omission of recording a purchase of equipment 2 years ago. C, because it is the only choice that requires a retrospective restatement since it is a prior period error due to an omission committed. Furthermore, letter A is a prospective application of change in accounting estimate, and letters B and D are retrospective application of changes in accounting policies. Thus, our answer for number 9 is letter C.
Okay, well said. Very good. For letter A, I want you to remember letter A. Many students would think that this is a change in accounting policy, but again, this is just a change in estimate. Letter B and letter D are indeed changes in accounting policy. Class, as an advice class, you might as well take down all examples you will encounter for changes in estimates and all examples you will encounter for changes in policies. Okay, you will encounter a lot of questions in which the only challenge on your part, class, is to classify whether it's a change in estimate or change in policy. And the simplest way to prepare for those kind of questions, class, is to make a list. These are the list for changes in accounting estimates and another list for changes in accounting policies. But definitely, it would also help if you remember by heart the definition for a change in accounting policy and a change in estimates.
Number 4. Which of the choices best describes the following statement? Our answer is letter A. So first statement is true because a change in accounting policy, to any extent that a change in accounting estimate gives rise to changes in assets and liabilities or relates to an item of equity, the entity shall recognize it by adjusting the carrying amount of the related asset, liability, or equity item in the period of change. However, statement number 2 is false because an application of an accounting policy for transactions, other events, or conditions that differ in substance from those previously occurring is not treated as change in accounting policy. Instead, it is the initial application of the standard.
Okay, that's correct. Number 10.
Which of the following statement is true? Letter A. Prospective application could be applied on the period of change only. Letter B. Retrospective application applies for correction of a prior period error. Letter C. Retrospective restatement applies for change in accounting policy. Letter D. All of these choices are true.
Our answer is letter A. Prospective application could be applied on the period of change only if the change does not affect the future. Other statements are false because it should be that the retrospective application applies for change in accounting policy and the retrospective restatement applies for correction of a prior period error.
While preparing for the comparative financial statement 2017 and 2018, you have discovered that there was an overdepreciation or overstated depreciation of an asset. Based on the foregoing, which of the following is false? So our answer here is letter A. If the error occurred on 2010, do not correct or restate at all since 8 years have passed already. So even if 8 years had passed before an error was discovered, it should be corrected or restated if what was omitted or misstated is material to the firm. It can only choose not to correct or make any restatements if it is immaterial and not because it had already passed 8 years ago.
Okay, that's correct. And B, C, and D class are the things that you have to do class in case there is an error. Number 4.
Prospective application refers to the following except. Our answer is C. Applying a new accounting policy to transactions, other events, and conditions as if that policy had always been applied, because C is not prospective application, instead it is retrospective application.
Okay. While letter A and letter B class clearly describes prospective application.
Number 6. In what order shall the application of an accounting policy be effective? 1. In accordance with the specific transitional provisions in the PFRS. 2. Retrospective application. 3. Prospective application from the earliest practicable period. Our answer, sir, is A, 1, 2, 3, since PAS 8 provided that the change in accounting policy should be applied in this particular order.
And this is what I'd want to remind you class. As a last resort for retrospective application class, if it's really impossible to apply retrospective application, the last resort would be to apply it starting on the earliest practicable period and then onwards. So you go to the earliest practicable period, which will normally be the last year class, the previous year, and you apply the change in policy from that year and until the next subsequent periods class. So I want students to understand that a change in accounting policy can also result in prospective application. When will that happen? Only when retrospective application is impracticable. But what do we mean by prospective application for accounting policy? It is applying the policy starting from the earliest practicable period. As part of treatment for a change in accounting policy class, if it's impossible to give it complete retrospective application, your final resort would be to apply it prospectively. Not just in the current period, but you try to apply it in the earliest practicable period. And in reality class, what is normally the earliest practicable period? It is normally the last year, the previous year. Number 8.
Which of the choices best describes the following statement? Statement 1. In applying accounting policy, the standard requires that the policy should be consistently applied for similar transactions, unless an IFRS specifically requires or permits categorization of items for which different policies may be appropriate. Statement 2. An early adoption of an accounting standard is that the voluntary application, and thus the entity does not have to comply with the transition provisions of the said standard. Our answer, sir, is letter C. Statement 1 is true while statement 2 is false because a standard is developed to ensure that financial statements from multiple companies are comparable, making the financial statements more credible and accurate. Hence, it must be followed. Additionally, if there are changes in the standards, it should also be applied if it makes that information more relevant and reliable.